Hi, everyone. It's Louis Fernandez here with the LRF Group with Berkshire Hathaway with EWM. Wishing you all a very happy new year. Hope you enjoyed your Christmas and Hanukkah and got together with your family and friends. I stayed local because we had clients coming in from New York and I had to show them some properties. We were able to get them under contract. We were excited about that. And also, we were able to get a couple of our listings under contract as well. So it's all good. My holidays will come in later. But I wanted to go over a report from Housing Wire about the correlation of the interest rates and how that plays with Treasury yield and the jobless claims and the economy. So, without any further delay, let's get straight to it and let's see if we can learn a little bit together. So, it talks here about the jobless claim keeps mortgage rates elevated. Wow, okay. So, how does that work? It says here today, the jobless claims data again showed why the mortgage rates continue to be elevated, confirming that the labor market isn't breaking. The labor market is getting softer, but hasn't broken yet, as it has before every recession post World War II. So here, the jobless claims, as it stand in December, we had about 211,000, uh, uh, which has come down significantly from just the previous months, and that we were at, I think, somewhere between the end of November, we were close to 240,000 jobless claims. So this should be actually, this is good. This is a good indicator, which people are getting back to work. They've got a job, but however, this can adversely affect right now where we are with regards to inflation and interest rates. Goes on to say here that the mortgage rates have remained mostly in range over the past 2 years, fluctuating between 6 and 8%. In late 2022, global markets faced turmoil and economic indicators suggested a weakening economy, leading the 10-year yield to drop around 3.37% before rebounding. And then in 2024, the labor market showed weaknesses, and the 10-year yield fell briefly below that to 3.80% level. This broke after three softer reports in the jobs week pushed the 10-year yield down to 3.6.2%. However, that concern dissipated when the jobless claims began to decline again. So when the jobless claim was up in these numbers, right, the yield was somewhere around here. However, as the jobless claims gets better, the 10-year yield, the 10-year Treasury security yield goes higher, and it's currently now at 4.57%. So why would the 10-year yield go higher? Well, it goes higher because as the economy starts growing, that could put concern by the Federal Reserve that the interest rates, that the economy is actually is heating up again, and they're afraid of the inflation effect of that could have. So as the Treasury yield goes up, then the Fed will raise the interest rates, and that is going to cause higher mortgage rates. So there's always usually a spread between the 10-year yield and interest rates, and it's usually sometimes the spread could be as little as 1.5% to as much as 3% range. So right now, currently, I think we have a spread of close to 2.5%, which it kind of tells you. So if the rates right here, the yield is 4.57%, interest rates is currently 30-year is at 7.1%. 15 is a little bit higher at 7.2. So you have a spread of about 2.5 to 3% in terms from whatever the yield is, the 10-year yield, and the interest rates. Another thing that's pushing the yield up is this report of the residential building construction. At standing in November, we have 956,000 employees in the construction market across the country. As you can tell, it's just been more and more people are getting employed, which is a good thing once again. However, as that number improves, unfortunately, the yield is going to go. The Treasury yield is going to go higher, and because it goes higher, then the interest rates as well. So it says here, you don't necessarily need to experience a jobless recession for mortgage rates to drop towards 6%. That's very true. As we've seen in 2023 and 2024, however, some implied softness in the economy or improved mortgage spread is essential, both of which we saw in 2024. If this trend continues and into 2025, the gaining rates near 6% will become easier. So it says the jobs week is next week, and we'll see the final report for 2024. One sector to watch is the 2025 is the housing start and the employment for construction workers. Even a slight decline in job growth data could push the unemployment rate to 4.3%. Additionally, improve the mortgage rate spread may result in lower interest rates for an extended period of time. So in other words, unfortunately, what they're saying is if the unemployment rate goes above currently 4.2%, that's going to bring the yield down and also the interest rate. But this is what talking about earlier, when the unemployment rate was as high as almost 15% back in 2020. It was already dropping down by I think by November it had dropped down to 6.7%. However, when the Biden administration kicked in and in January and February, they were able to bring the unemployment rate down significantly, but they pumped in close to $7 trillion into the economy to do that. Now, why would they want to pump in so much money into the economy? Well, because they overstimulated the economy, I think, in my opinion, and they created this artificial growth by giving people, all these paychecks and bonuses by the federal government, and so consumers were walking around with stupid money in their hand, and they were spending. But the intent was that the more they spend, the more businesses will hire and grow, and that would bring the unemployment rate even further down. But I think there was too much money that was infused into the economy at the time, and because of it, you created an inflationary effect. At one point, we had the highest inflation rate in 40 years in this country, and ever since then, the current administration has been battling that inflation monster to keep it down. And the only way to keep it down, well, one of the ways to keep it down is to raise the interest rate that makes the cost of borrowing money more expensive. And because when you do that, money becomes less available in the market, you start drying it up a little bit. But unfortunately, businesses can't grow, they can't borrow, and when that happens, and especially when consumer can't spend, businesses start to contract and then start laying people off, and they're the first casualty of war. And this is what then happened here. You have the unemployment rate now. At one point, it was back then at 3.5%. It's now at 4.2%. We had it down also as well here at 3.5%. But at this time, we had already inflation that was out of control. So inflation rate has come down, which is good. It's much lower than it was, but it's still high. And unfortunately, it's the worst tax that a consumer can have, because inflation is a tax that you pay every day, and whatever products you're purchasing, your groceries, if you're purchasing an automobile, especially if you're buying a house, the construction costs, etc., you have an inflationary price tag on every item, and it's a tax that we pay on a daily basis, and that's why people are hurting, and the economy isn't the way that it is currently, unfortunately. So that's how the 10-year yield can affect interest rates. And I hope this information has been helpful. It's a little bit convoluted, it's a little bit confusing, but just to understand, recap. As the 10-year yield rises, so will the interest rate, and as the 10-year yield should drop, so will the rates should drop as well. And it's based on how the economy is doing. If the economy is doing very well, unfortunately, the 10-year yield will rise and the rates will rise. However, another way, though, I think that you can affect the inflation and keep it down is by producing more products and more services. If you produce more products and more services, then it doesn't matter if the economy is doing well or not, because you're not creating an inflationary animal on the side. But when you have too much money chasing too few goods and products and services, and that's what we had in 21 and 22, and currently, you have an inflationary effect, and that's what again the only way then to address it is to dry up the money, and by drying up the money, you're causing unemployment and you're causing hardship on the consumer. So thank you again for watching, and keep watching out for us, because we're watching out for you in the best interest of your property. Till next time, all the very best. Bye-bye.